Assalamu alaikum everyone. Good evening. Welcome to day 2 session of AFM webinar. Hopefully all of you are listening. So our today's topic is merger and acquisition. It's a very important topic and we will be covering the knowledge checklist, examples of requirements, common mistakes, and obviously how to score the maximum marks. Guys, voice is clear, right? Please. If voice is clear, please tell. Thank you so much. So hopefully you guys have completed the last day question. We have covered almost all of the theoretical part. So at the end of today's session, we will discuss the remaining part of that question. Okay. So let's have a discussion on merger and acquisition. This is very important topic, and normally many conceptual requirements are being tested from this area. So let's have a discussion on the knowledge checklist. This is important. First is what kind of theoretical area will be tested from this area, from this merger and acquisition topic. Look, these are the full checklist of all the theoretical areas, but obviously types of merger will not be tested in the question. It's very simple, but comparison of organic growth and inorganic growth can be tested. In many past papers, examiners specifically ask that why a company is going through the acquisitions, why a company is growing through acquisition. I still remember a question named Vogel company. The A part of that question is tested from this area, that why your company is growing, why your company is expanding through acquisition, why not through the organic growth. You have to answer, and obviously you will be able to answer if you know the comparison between the organic growth and the inorganic growth or the growth through acquisition. So guys, you should know the difference between the organic growth, the internal growth, or growth through the acquisition, the external growth. Obviously in growth through acquisition, it will be a quick growth. You can easily enter into the target market. You can easily get the required business, but it will be costly. And there will be a lot of challenges required in growth through acquisition. So you should know, examiner can test 3 to 4 marks from this area. It's very easy, by the way. What are the reasons for acquisition? Actually, if you know the reasons of acquisition, then you will also know the reasons of failures. So reasons of acquisition, why you are acquiring the other company. You are acquiring the other company because the other company is cheaper. You are acquiring the other company for synergy. You're acquiring the other company because the other company is in your field. You're acquiring the other company to expand the market share. You're acquiring the other company to get the access of some key formulas or key areas. So you should know the reasons for acquisition. Then types of synergy. Types of synergy has been tested in the past paper many times. In 2 to 3 questions, examiner has tested that what are the types of synergy and identify the types of synergies in the scenario. I remember a name of question HAVCO. In that particular part, in A part, examiner has tested 9 marks theory from this area. So you should know the different types of synergy, the revenue synergy, the cost synergy, and especially the financial synergy. There are many parts in the financial synergy as well. So you should know the types of synergy. Types of synergy can be tested in the exam. So in merger and acquisition, theory is very important. You should know the theoretical stuff. Why acquisition fail and how you can overcome these risk of failures. Why acquisition fail? Maybe acquisition fail maybe because of you fail to value the company using proper method, because of valuation risk. Your company fails because of due diligence risk. You unable to properly evaluate that company. Your due diligence process was weak. That's why your acquisition failed. Maybe because of regulatory problem. You unable to evaluate the regulatory risk attached with the acquisition. So why acquisition failed? Because of valuation risk, due diligence risk, regulatory risk, and integration risk. Integration problem, integration risk. So these are the different reasons that acquisition, generally the merger acquisition fails. So you should know all of these reasons. Defenses to take over merger acquisition. What are the defenses for the takeover, for the merger, and for the acquisition? You should know all the defenses. And examiner can test these defenses in the exam. Then methods of financing merger. What are the different methods of financing merger? You should know that how to acquire the company using cash offer, how to acquire the company using share offer, how to acquire the company using bond offer. Obviously in cash offer, if you acquire the other company using cash offer, it will be, you can immediately acquire the company. There are different pros and cons attached with the cash offer, with the share offer, with the bond offer. For example, if you acquire the other company using cash offer, so for the target company, cash is the immediate relief. Cash is the immediate return for the target company, and it is a realized return. There is no uncertainty involved. There is no uncertainty involved with it. But for the cash offer, target company have to pay immediate capital gain tax, and normally cash offer is lower than all the others offers. And cash offer, for the acquirer perspective, in cash offer they will pay the cash and they will wholly control the company. Please guys, there is still some issue with the voice. Okay, it's clear. So let me explain this. So let me explain this: cash offer, then share offer, and then the bond offer. So let me explain the cash offer from the perspective of acquirer, from the perspective of target company. This is very important. You have to have a grip on the comparison between cash offer, bond offer, and share offer. It will help you in the discussion of the question. So why acquirer? preferably select the cash offer. It's cheaper, it's quicker. You do not have to share control with the target company. No dilution of control. Why target company preferably select this? Obviously, it is quicker. It's a realized gain. They can invest in other avenues, but there are certain problems attached with it. Normally lower return, and you have to pay immediate capital gain tax. You have to pay immediate capital gain tax. So these are the pros, these are the cons attached with the cash offer for the target company. Obviously, for the acquirer, there are certain benefits. These are the benefits for the acquired company. Okay, what about the share offer? So you should learn to discuss these things. What are the benefits for the acquirer and what are for the target company? For acquirer, they do not need to arrange cash. Do not need to arrange cash. They do not need to arrange cash. Using bootstrapping, they can increase the EPS. They can increase the EPS. This is a very fantastic process where you will acquire the cheaper company by issuing your overvalued shares. So issued number of shares will be lower, income will be greater, and overall EPS will increase. I will explain. For example, this is acquirer, this is target company. Guys, 1 minute please. Okay, let me explain the bootstrapping. For example, this is a target company, this is acquired company. So let me explain the bootstrapping. It's a very simple process. Sometimes examiner will use this bootstrapping language in the question, so you should know about this. For example, P ratio of a company is 20 and P ratio of target company is 10. Number of shares are 100,000, number of shares are 50,000. Market value per share is $100. Market value per share is $50. Can you calculate the EPS, guys? Can you calculate the EPS? If P ratio is given, market value is given, P ratio, EPS will be 5, right? And let's suppose EPS here will be again 5, right? So the total earnings, let's calculate the total earnings. Number of shares into EPS, 500,000. And here total earning is 250,000. So what is the total earnings? Please add these two, it will be 750,000, right? $750,000. So the total earnings are 750,000. Okay, we as acquirer, we will issue our one share. We will issue our one share to acquire the 2 shares of the target company. We will issue our one share in order to acquire the 2 shares of the target company. So for 50,000, how many shares we will be issuing? For 50,000 shares, how much the acquirer will be issuing shares? 25, right? 25,000. So now after the acquisition, how many shares the group have? 100,000 plus 25, 125,000. So what will be the EPS now? 750 divided by 125, it is equal to 6. It is equal to 6. Please confirm. Right? This is called bootstrapping. If we look carefully, if we look using our accounting sense, if we look at this data using our accounting sense, acquired earning was 500,000, target earning was 250,000, and if you add the earning of these two accounts, it will be equal to 750,000. Technically, there was no synergy. 2 plus 2 is equal to 4. If you add 500,000, if you add 250,000, it will be equal to 750. There is no synergy, but still EPS moves from $5 to $6. Why? What is the reason? Just because acquirer has acquired the cheaper company by issuing its expensive share, by issuing its higher market value share. So guys, remember, whenever higher P ratio company acquires a low P ratio company, EPS will increase. This is called the bootstrapping. So in bootstrapping, In bootstrapping, EPS will always increase. Okay, in bootstrapping, EPS will always increase. You got the point? That is called the bootstrapping. Okay. What are the advantages for the share offer? But why target company preferably choose the share offer? Why? What is the reason? To get part in group's energy, to get ownership of company, to get future benefits of group. But there are few problems with it. If I, being the acquirer company, if I give you the shares of my company, it is unrealized benefit. It is unrealized benefit. So what are the problems with a share offer? Guys, what are the problems? It is unrealized return. Unrealized return. If share prices are volatile, return is expected to come down. Return can be lower in future. Return is expected to come down. So I was just discussing the theoretical aspect for method of financing merger. So whenever you are revising whenever unrealized profit means, if I give you the cash, it is the realized profit. That means you have cash in hand, you can invest somewhere. But if instead of cash, if I give you the share, this is unrealized benefit. You have to sell the shares in the market in order to have a cash. And obviously, if you sell the shares in the market, if share price increases, you will get benefit. If share price decreases, you may face the loss. So that's why if you are receiving consideration in form of shares, that is risky compared to if you are receiving consideration in form of cash. So that's a basic discussion on method of financing merger. Now, next is key aspects of takeover regulation. You have to remember the key aspects of takeover regulation. This is very important. An examiner normally tested this type of theory. So it's my request, whenever you are revising the theoretical part of merger, the theory of merger, this is a checklist. You have to learn all these points. Read and learn these theory points. Okay, bond is slightly different. In bond, for example, if I am giving you the bond and you are the target company, try to listen this. I am giving you the bond, I am acquirer, you are target company. So first of all, let's discuss from the perspective of acquirer. If I am giving you the bond, you know what? It's a kind of delayed payment. I'm giving you the piece of paper only. Whenever the bond will be redeemed, then you will receive the amount. For example, if a bond is a duration of 5 years, I will be paying after 5 years. I will be paying after 5 years. So bond is a delayed payment for the acquirer. This is a huge benefit. Delayed payment. Currently, I am giving you the piece of paper. And if bond is a life of 5 years, at the end of 5th year, you will be receiving money. So for acquirer, this is a huge benefit. What about the target company? They will no need to pay tax. This is less risky because bond is involved. Confirm that you will receive the amount, and plus you will also receive the interest regularly plus the redemption value. So normally the bond return is higher than the cash offer, but maybe lower than the share offer. So if target company is receiving the bond, they do not need to pay any tax. It is less risky, and you will be, being a target company, you will be receiving interest over the period of time plus the redemption value at maturity. But there is one problem attached with it. What is that? What is that problem? You will not be receiving actual income until the maturity. It's a delay payment. So please, before going to the exam, kindly revise this knowledge checklist. The next is method of valuation. Method of valuation. Okay, in method of valuation, different methods are involved. The most important is cash flow based model. The most important is cash flow based model. Cash flow based model is very important. In cash flow based model, examiner can test different valuation, free cash flows, free cash flow to equity, combined company value, but the most important are free cash flow to firm and free cash flow to equity plus the combined company value methods. Combined company value methods. These three are very important. And then the P ratio method is important. So if I say on this slide, I have written all of the methods which are applicable in AFM. But the most important are free cash flow to firm, free cash to equity, combined company value, and the P ratio method. These four methods are very important. So what you have to remember in free cash flow to firm? Obviously, you have to remember the formula of free cash flow to firm, and everybody obviously will remember because it's part of your syllabus. But the most important thing is you have to discount free cash flow to firm with WACC. An answer will be market value of business you have to deduct the market value of debt, then you will be arriving at market value of equity. So whenever free cash flow to firm is given, always discount with the WACC, or vice versa. Whenever WACC is given, if WACC is given in the question, calculate free cash flow to firm and discount the free cash flow to firm with the WACC, and answer will be market value of business. Do not skip this. You have to remember that market value of business is not the right answer. You have to deduct the market value of debt in order to calculate the market value of equity. I have seen many students doing this part wrongly. They able to understand that WACC is given, so we have to calculate free cash flow to firm. But remember, the answer of free cash flow to firm is market value of business. You have to deduct the market value of debt to arrive at market value of equity. So whenever free cash flow to firm is given, discounted WACC, calculate market value of business, deduct the market value of debt, and calculate market value of equity. Next is, if free cash flow to equity is given, or if cost of equity is given. If cost of equity is given, use free cash flow to equity and calculate directly the market value of equity. Directly market value of equity. If cost of equity is given in the question, you will be calculating free cash flow to equity and discount all the free cash flow to equity at KE. Answer will be directly market value of equity. There is no need to do anything. There is no need to do anything. Okay, next is combined company value. So what you have to do in the combined company value, there are different methods to calculate combined company market value. This is very important. Please pay attention. Combined company value. Combined company value. There are different methods. Using those methods, you can calculate the combined company value. Obviously, based on question data, you have to identify that which method has been tested in the exam. Number one method, combined earning method. Combined earning method. What is that? First of all, calculate combined earning. Combined earning. Acquirer earning. Earning means profit after tax. Target profit after tax plus synergy per year. Synergy per year. First of all, calculate the combined earnings. That is acquired profit after tax plus target profit after tax plus synergy per year. Synergy per year will be given. You have to identify synergy per year will be given. Okay, then multiply the combined earnings with combined PE ratio, or the suitable word is group PE ratio, or the acquired PE ratio, combined PE ratio, group PE ratio, or the post acquisition PE ratio, or the post acquisition PE ratio, post acquisition PE ratio. So this will be your combined equity value, combined equity market value, combined equity market value. This is number one step. Calculate combined earnings, multiply with the combined PE ratio, that's equal to combined market value. So your question will be, sir, how do we know that this method has been tested in the question? Simple answer. If group PE ratio, if combined PE ratio, if the post acquisition PE ratio is given, it is guaranteed, it is almost sure that this method has been tested. Like in yesterday class, I was telling, I was explaining that if subsidized loan is given, it is almost sure that APV has been tested. So guys, if combined PE ratio is given, it is almost sure that this method has been tested. Okay, second method is combined FCFE method. Okay, what is that? Number one step. Calculate combined FCFE. Okay, what is that? You will take the acquirer FCFE. You will take the target FCFE. You will take the synergy cash flow. The synergy cash flow per year. Add all the free cash flow to equity, or add all the free cash flow to equity. Calculate combined free cash flow to equity. Combined free cash flow to equity. And second, multiply combined FCFE with price to cash flow ratio. Price to cash flow ratio. And that price to cash flow ratio will be of the group. It will be a group price to cash flow ratio. Price to cash flow ratio. Here you come. Answer will be combined equity value. Combined equity market value. Third step. Third method. Total synergy is given. Total synergy method. And what is how to calculate combined equity market value? You will add acquirer equity market value target equity market value plus add total synergy. So directly total synergy will be given. You will be adding the acquirer equity market value, target market value plus total synergy, combined equity market value will be given. So guys, examiner has tested many questions on all these three methods. Like on first method, there is a question named Vogel. On second, there is a question named, please correct me for the spelling, Celeron type name. Havco. Only one question on the third method. Sigraco. So these are the questions which has been tested on these methods in the past exam papers. And all the recent attempts question. Recent attempt questions. So these are the three methods to calculate the combined value, and these are the past papers in which these methods have been tested. Okay, there is one more method. Let's discuss on the next slide. That method is combined FCFF method. So guys, first step you will be calculating combined WACC. Obviously, there's a list of steps involved. First step is to calculate the ungeared beta of target company and the acquired company. Then you will calculate the combined beta asset of the group. Then you will re-gear with the post-acquisition gearing, put into the CAPM to calculate cost of equity. Using the group KD, you will calculate the combined WACC. So first step is to calculate the combined WACC. Second step, calculate combined FCFF. Third step, discount combined FCFF at combined WACC to calculate group market value of business. This is the only method in which answer will be market value of business because you have used FCFF. So the combined equity value will be equal to market value of business minus group market value of debt. So that will be equal to combined equity value. So guys, it's my request that this is very important. Whenever you are revising the method of valuation, you should revise. You should have a grip on FCFF, FCFE, and the combined company valuation methods. There are 4 methods of combined company valuation. Number 1 is combined earning method. Number 2 is combined FCFE method. Number 3 is total synergy method. Number 4 is combined FCFF method. Combined FCFF method. Okay. Many questions has been tested on almost all of these 4 methods. So you should have a command on these topics. Next is method of financing merger. Previously we have discussed theory on these methods. Examiner also tests numerical on these topics. Examiner also tests numerical on these topics. So let me explain that how you will solve in the question. Guys, please pay attention. Your next 10 minutes are very important. And your next 10 minutes are going to change the perspective of merger and acquisition question. So please pay attention. Your next 10 minutes are very, very important. So guys, whenever you are solving share for share exchange question, how to solve the numerical part of it? Whenever you are solving the share for share question, share for share, how to solve this share for share question? Okay, you have to make a table here. And what is that? What you will write? First of all, you write pre-acquisition detail. Pre-acquisition detail. Pre-acquisition information. Okay, what is that? You will write acquirer company name, any name which is given in the question, right? Target company name. You will write the shares of the acquirer, market value per share of the acquirer in the target company, and the market value, total market value. Obviously, total market value means pre-acquisition market value. So guys, this information will be available from the scenario. All this information will be available in question. Number of shares are given normally in the balance sheet. Market value per shares are given. You will multiply the market value per share with the number of shares to calculate total market value. Sometimes total market value is given. Sometimes total market value is given, and you will calculate the market value per share. So all of this information will be available from the question. Okay, now the very important part. Guys, let me explain on the Excel. First of all, you will write pre-acquisition information. Pre-acquisition information. Please ignore the spelling mistake. First of all, you will write the acquirer name. Acquirer name. Then you will write the target name. Okay. Acquirer name and target name. Then you will write the shares. Then you will write the market value per share and the total market value. So I'm just writing few numbers by taking assumption. Let's suppose number of shares of acquirer are 1000 million. Number of shares at target company are 400 million. Market value per share is $10. Market value per share is $6. So it will be equal to 10,000, 2,400, and the total will be 12,400. So all of this information will be available from question. Now, the important part is post-acquisition information. You will write the shares here, market value per share here, total market value here, post total market value. Guys, remember one thing, rule, the acquirer shares will remain same. So you will simply copy the acquirer shares here. Acquirer shares will remain same. Acquirer shares will remain same. Okay, now using any method, calculate combined market value. So what are the methods? Methods can be combined earning, combined FCFE, total synergy, or combined FCFF. use any method and write the combined market value here. Let's suppose combined market value is 18,000. Combined market value is 18,000. Let's suppose, guys, combined market value is 18,000. Okay. Now it will be stated in the question that for every 2 share of the target company, we are giving 3 shares. For every 1 share of the target company, we are giving 2 shares. For every 2 shares of the target company, we are giving 1 share. So let's suppose I'm assuming it is given that for every 2 share of, for every 3 share of target company, we are offering 2 shares. Okay, let me change the price slightly. 5.5. Okay. So for every 3 shares of target company, we are offering 2 shares. 400 divided by 3 into 2. For every 3 shares, we are offering 2 shares. So we are offering 266.67 million shares, right? Take the total number of shares. So now combined shares are 1266. Calculate the combined market value. Combined total market value is given. Combined shares are given. Combine this divided by this. Obviously, both of these are shares of the group. So this combined market value will be same. This combined market value will be same. Now calculate the acquirer part of the post acquisition value. So what I have done, let me explain everything again. Guys, let me explain everything. First of all, write shares, market value per share, total market value. Write the acquirer company name, target company name. Write the pre-acquisition shares of acquirer target, pre-acquisition market value of acquirer target, calculate the total. Then for post-acquisition, shares of acquirer will remain same. Combined market value you will be calculating using any given method. Then it will be stated in the question that for how many shares you are issuing how many shares. So for 3 shares of target company, we are issuing 2 shares. So we are issuing 266 million shares. The total number of shares are 1266. Total market value is given. So let's calculate the combined market value. 14.21. So it will be same. So now let's calculate the value. So next step will be the gain loss. This is the acquirer post acquisition value minus the pre-acquisition value. This is the gain. This is the acquired target company post acquisition value minus the pre-acquisition value. This is the gain. And if you want to calculate the percentage gain, gain divided by the original market value. Gain divided by the original market value. So this is the percentage gain. And even if you want to calculate the ownership of the company, post acquisition ownership, this is the total shares, 1000 divided by this. This is the total shares, 266 divided by this. You can also calculate the ownership. So this is a brilliant way to calculate percentage gain, simple gain, number of shares, and you always will be able to calculate using this method. This is for share exchange. Right? This is for share exchange. By tweaking, by changing it, somehow you can use it for the cash offer for the other offers. Let's suppose, let me explain it for the cash offer. Let me explain for the cash offer. Cash offer. This whole thing will remain same. And obviously we are not issuing any share here. So it will be ended. Okay. Now for cash offer means we are offering, for example, for every share of the target company, we are offering $7. For every share of target company, we are offering $7. $7 means we are offering 7 into 400, right? We are offering 2,800. So total value is 18,000, guys. Total value is 18,000. We have given cash 2,800 to the target company. So what is the remaining value? So 15,200 will be the remaining value. So now compare this 15,200 with 10,000. 5,200 is the gain of the acquirer. 2,800 compared with 2,200. 600 is the gain of the target company. So let me explain it all together. I think everybody will be clear on this pre-acquisition information, right? Nothing wrong with the pre-acquisition information. Okay. Now, shares of acquirer will remain same. Calculate the combined equity value, that is 18,000. I'm assuming it is 18,000. It's just a number. It's assumed number 18,000. By the way, we will solve it in a past paper question. By the way, we will solve this in a past paper question after a few minutes. Don't worry about it. Don't take stress. This is a brilliant way of calculating these percentage gain losses. Otherwise, seriously, it's a very huge problem for everybody to tackle the merger acquisition question. So guys, I'm assuming that we are offering $7 cash for every share of target company. 400 million shares, we are offering $7. It's just an assumption. So that means we are offering 2,800. So if we have given 2,800 to the target company, so remaining value will be available to the acquirer, 15,200. So 15,200, sorry, I have calculated in a wrong cell. It should be written here. So 15,200 is the post value of the acquirer. What was the pre-value? 10,000. So 5,200 is the gain. We have offered 2,800 to the acquirer. Actually, its value was 2,200. So 600 is the gain. Now convert into percentage gain. Divide with the pre-acquisition value. With the pre-acquisition. And guys, if you want to calculate the market value per share, you can calculate 15,200 divided by 1,000. Okay. Even you can use it with a mix offer. With a mix offer. In mix offer, you have to slightly write this 18,000 in one cell below. You will write 18,000 here. And obviously here you are offering two offer and write 12,200 here. And obviously you will be offering two offer here. Cash offer and share offer. Okay. So you are offering two things to the target company. In mixed offer, you are offering two things to the two consideration to the target company. So you can solve obviously by using common sense. You can solve this in the question. So do apply in the questions. So let's move to our previous slides. By the way, we will be applying this in the past paper question. Don't worry about that. Common requirements. These are the copied requirements from the past papers. Examiner often test market value of equity. Often test market value of equity before acquisition, combined equity value, percentage gain, and then you have to discuss the reactions, combined equity value, additional value, the gain, shares of the gain from the combination, current equity value. So it's very common. You will be calculating equity value. Okay. So what are the common mistakes? Inability in identifying methods to calculate market value. Students often confuse in identifying the correct valuation method. Confusion in applying FCFE and FCFF, I have discussed that. Inability in identifying methods to calculate combined market values. Guys, there are four methods to calculate combined market value. I have explained all the four methods. Please now do not confuse these methods. Error in calculation of gain or loss to both acquirer and target company. This is a SWARE problem. We have a solution. We have discussed that. Unable to understand requirement of the question effectively, that especially the theory one, that what examiner has asked. Students don't know the difference between the assumptions and the limitation of the method. This is very this is the problem. There is a difference between assumption and limitation. Assumptions are which you have taken in the question. For example, if you have taken the assumption that tax rate will remain constant for next 5 years, this is the assumption. What is limitation? Limitation is you have assumed that tax rate is remain constant for the next 4 years, but if government changes the tax rate, your calculation will be entirely different. So you should apply the difference between assumption and limitation. And guys, if you are solving investment appraisal question and if you are solving the merger acquisition question, always write that these figures are prone to error. These figures are prone to error, and management should apply sensitivity analysis, scenario analysis to improve the future estimates. Prone to error. All of the estimates are obviously prone to error. So you should apply the sensitivity analysis, scenario analysis to improve the estimates. Okay. Because in AFM we are forecasting the data, and remember, whenever we are forecasting the data, we are taking some subjective assumptions. And because of those assumptions, there can be mistakes, and obviously you have to analyze your data by applying different scenarios. For example, if I ask you that what will be the future of stock market, and you are the analyst there, you will say that sir, future is brilliant, that is my guarantee. That is a wrong way of predicting the future. Analysts will never predict the market value without taking the assumptions. You have to take the assumption, and obviously those assumptions are the limitations. Those assumptions can become the limitations in future. Okay, these are the points which you should cover in order to score the maximum marks. Thorough understanding of the topic knowledge. You should elaborate all calculation in steps because each steps carry 1 to 2 marks. If you are unable to recall any step, take assumption and move on. Take assumption and solve the remaining question. After calculations, always discuss the result of calculation. Guys, this is very important point. Whenever you do the calculation, always discuss the result of calculations. Learn to make report because 4 marks are there. Write complete sentences. Read theoretical answers of the examiner to learn the expression. Solve maximum past papers question for practice, but do expect different scenarios. So these are the simple and important points to score the maximum marks. So now we are going to solve a past exam paper question. Please open March, June 21. March, June 21 past exam paper question. First question, March, June 21. Guys, please open this. You have a minute to please open this past paper question from the technical article, March, June 21. Okay, requirement is explain why a regulatory framework related to merger and acquisition is necessary to protect the interest of shareholders and other stakeholders. It's a simple question, that why a regulatory framework related to merger and acquisition is necessary to protect the interest of shareholders and other stakeholders. It's a 5-mark question. Second is discuss the 2 theoretical propositions as raised by company's board of directors in relation to a company's capital structure. There is another theoretical question. You have to discuss the 2 theoretical propositions raised by the board, and it has a 6 marks. Third is prepare a report for the board of directors which estimates the value of each Cavaco shares if it is demerged and listed as an independent company. Demerged means company will become a separate company. So estimate the value of each Cava company share if it is demerged and listed as independent company. Second is estimate the additional equity value created when combining Lehlaco and Cavaco. Additional equity value created. Okay. The percentage gain to each of the company shareholder group under each payment method. This is the percentage gain which we are going to calculate using the table which we have covered. Next is impact on the Lehla company capital structure under each payment method. You have to calculate the capital structure of this company. Next is what is the report? Evaluate the financial evaluate the financial and other factors that both company shareholders would consider prior to agreeing to the acquisition and the impact on the company capital structure under each payment method. So this is the question. So let's discuss the scenario. First of all, the introduction. Company is a large listed company involved in two business sectors. The C company is a large listed company involved in two business sectors. Its main business is in the production of food and drink for supermarkets and other large traders. It also owns a chain of coffee shops nationwide. C company board of directors thinks that the company is undervalued and is of the opinion that it should focus on the rapid innovation taking place in the food and drink production sector. Therefore, the C company board has decided to unbundle. Unbundle means you will be selling some departments from your group. You will be removing some companies from the group. So the board has decided to unbundle the coffee shop business into a company called Cavaco. Okay, the C company will then either demerge Cavaco through a spin-off. Spin-off is a process in which you will separate this company from the group. Management will be different, but overall ownership will be same. Owner will remain same, but the management will be different. Or sell Cava company. C company will then turn its full focus on its remaining business of food and drink production. So guys, C company is a large company. It involved in food and drink for supermarkets. It also own a chain of coffee shops. So what you are going to do, you want to sell or spin off the coffee shop business and name the new company Cavaco. Initially, C company shareholder will own Cava company on the basis of owning one Cava company share for every C company shares owned by them. That means if C company 100 million shares, Cava company will also be having 100 million shares, because C company will own Cava company shares on the basis of owning one Cava company share for every C company shares owned by them. Layla company is a large unlisted company controlled by 20 shareholders who all have a significant stake in the business. Layla company owns a number of hotels around the country and is looking to diversify into the coffee retail business. Layla company has approached C company about the possibility of purchasing Cavaco. Layla company will finance the purchase either through a cash or a share offer. If Cava company is demerged, it will be listed on the stock exchange as an independent company. C company is unsure whether to sell Cava company to Layla company or to demerge into an independent company. So you are the management of the C company. You want to unbundle the Cava company, but you're not sure whether to sell the Cava company or to make it a separate company. Okay, obviously we will help it. Further clarification has been sought by the Layla company board on the following two areas. Number one, company CEO has determined that a regulatory framework in the area of merger and acquisition is designed to protect the interest of shareholders and other stakeholders. He wants to find out why there is a need for regulatory framework. Guys, let's discuss the A part. There are some reasons that there is a need for regulatory framework. Regulatory framework is there to protect the right of all the shareholders. Regulatory framework is there to protect the right of all the shareholders. Regulatory framework is there especially to protect the right of minority shareholders of target company. Regulatory framework is there to protect the right of minority shareholders of the target company. Regulatory framework is there to control the management of the target company so that they can work on behalf of their shareholders. Regulatory framework is there to set the guidelines for the proper merger and acquisition steps. For example, proper information should be provided if you want to acquire some company. For example, you are the acquirer, another company is the target company. You should provide the proper information to the other company. So, and at the same time, target company also provide all the information to the acquirer company. And you should also, if you want to acquire the other company, you have offered the other company. Now you should give the proper time to the other company so that other company can take the informed decision. So if there is a regulatory framework, it will ensure the smooth transaction of merger and acquisition. So that is the discussion required for the A part. Discussion required for the A part. Explain why a regulatory framework related to merger is necessary. Remember, regulatory framework should be there in order to protect the rights of shareholders. Next, you will write regulatory framework should be there in order to protect the rights of minority shareholders, rights of shareholders if management is not acting on behalf of the shareholders. Regulatory framework will give you the guidelines for the smooth transaction of merger acquisition. For example, proper exchange of information, proper time will be given so that other party can take the informed decision. Okay, so that was a discussion of A part. Next is the acquisition of Kava company will be a major investment for Lalaco, and its board has concerned about how the acquisition will be financed. The board has heard that there are several theories explaining the capital structure of a company, including the following two propositions. Number one, company should maximize its debt financing. Number two, too much debt can be harmful to a company and there needs to be a balance between equity and debt financing. So guys, this is a very easy question and 6 marks were given for it. Discuss the two theoretical propositions. Obviously, you will explain that company should take maximum amount of debt. According to the MM theory, if you take the debt, it will create a tax saving, it will create a tax shield. So more you take the loan, more it will create the tax saving and your company value will increase. Your cost of debt will be cheaper, cost of equity is expensive. If you take more loan, WACC will decrease and it will increase the market value. But remember, debt will give you benefit up to certain point. If debt becomes expensive, the benefit of debt will become lower than the cost of debt, and at that point company should stop taking more loan. Company should keep on raising new loan till the point where benefit of getting loan is more than the cost of additional loan. But once the cost of the new loan becomes equal to the benefit of the new loan, you should stop taking the debt. So second point is too much debt can be harmful. Yes, too much debt can be harmful because if the company is taking too much debt, the cost of the new loan will become higher than the benefit of the new loan. So the KD will increase, the tax saving will not be there. So cost of capital will increase, cost of debt will increase, and the market value of the company start declining. This is the simple explanation of Modigliani and Miller theory and static trade-off theory. What is static trade-off theory? Keep on raising the new debt till the benefits of debt is greater than its cost. Once the benefit and cost becomes equal, then stop taking new debt. So it's a very easy part. Both of A and B part, 11 marks were very easy. Next is I'm at exhibit number 3. At exhibit number 3. Extract from C company financial statement are as follows. Share capitals are given $1,000 million and number of shares will be 2,000. Non-current liabilities, loan notes A is given, loan notes B is given. C company shares are trading at $2.45 and have an equity beta of 1.3. So this is the equity beta of the whole group, equity beta of whole company. The part of the business which will become Kava company accounts for 24.5% of the C company total market value. So that means you want to sell 24.5% of the total equity value. So 24.5% belongs to the Kava. 24.5% belongs to the coffee business. Kava means coffee business. Next is C company loan notes A currently have a total market value of $2,100 million. Loan notes B has a market value of $400 million. The pre-tax KD is 4.3% for the A and 4.1% for the B. After the unbundling, after the separation, the loan note B will be serviced by the Kava company. So Kava company will receive the loan note B. And pre-tax KD will increase by 0.3. Previously it was how much? 4.1. So it will increase to 4.4%. It will increase to 4.4%. Layla company debt to equity ratio is 40 to 60% and it has 1,200 million shares. The coffee retail industry is dominated by the Bunico, a large listed company which owns many coffee shops around the world, around the country, sorry. The average asset beta of the coffee retail industry is 1.5. This is important in order to calculate the Kava company cost of equity. All companies tax rate is 20%, taxes payable in the same year, risk-free rate is 3% and market premium is 7.2%. Okay, next is the following estimated information will be applicable to the Kava company if it is demerged. C company sales revenue is 4,500 million. This is the C company whole value, of which 20% relates to the Kava company. It is estimated that after Kava company is demerged, its annual sales revenue growth will be 6%. The profit margin before interest and tax will be 21% for each of the next 4 years. For each of the next 4 years. And next is, it can be assumed that current tax allowable depreciation will remain equivalent to the amount of investment needed to maintain the current level of operation. Guys, this is a golden statement. This is a golden statement. Let me tell you the significance of this statement. Whenever this green highlighted statement is given in the question, it is guaranteed that free cash flow method has been tested. Whenever this green highlighted text will appear in the question, it is guaranteed that free cash flow method has been tested. Okay, next is, but that Kava company will require an additional investment of assets 0.25 for every $1 increase in sale value. For every $1 increase in sale value. After the initial 4 years, annual growth rate will be 2.5% for the foreseeable future. Okay, the last point is, last exhibit is the following estimated information applies to the acquisition of Kava company by the Layla Co. If Kava company is acquired, average PE ratio for the hotel industry is 15.6. However, the Layla company PE ratio is estimated to be 10% lower than this. Okay. Extract from the current statement of profit and loss of the Layla Co and the Kava company. Profit after tax are given after the acquisition. it is expected that PE ratio of the combined company will be the midpoint between the individual two companies' PE ratio. Guys, please tell me which method we will use to calculate the combined value. Which method we will use to calculate the combined value? Combined earnings, P ratio, combined earnings, P ratio. Excellent, excellent. The annual after-tax profit will increase by 62 million. 62 million. And the last para is company has proposed to pay for acquiring Cavaco either through a cash offer of 0.66 for a Cava company shares or 1 Layla company share for every 3 shares of Cava company. And Layla company will borrow the money need to pay for the acquisition. Okay, this is a very important question and we will be solving. We have discussed the first two parts. We will be solving. First of all, we will calculate the value of Cava company if it is demerged. Then we will solve the second and third part. And after solving this C part, you will be able to solve the percentage gain or loss using my method. Okay. So let's have a break for a few minutes. And we will be joining back at 9.45. Okay. So let's meet after 15 minutes. Welcome back, guys. So let's solve all the parts one by one. So let me open the spreadsheet. So the first part is estimate the value of each Kava company share if it is demerged and listed as an independent company. Okay. Estimate the value of each Kava company share if it is demerged. By the way, I have already solved. That's why it is saved here. So let me so let's solve the first part. Part C1. We can also say that this is appendix 1. Appendix 1. And what was the requirement? The value of each Kava company share if it is demerged. Value of the Kava company. So before calculating the value, we need to calculate the cost of equity. And remember, the total equity value of C company is 2000 shares into 2.45, and Kava company has 24.5% of that value. So market value of let me calculate that. Market value of C company. Okay, let's calculate the direct value of Kava company. Number of shares are 2000. 1000 divided by 0.5 into 2.45, and we have a share of 24.5%. 1200, almost 1200 million. 2.45 into 2000, and we have a share of 24.5%. 2.45 into 24.5%. Okay, this is the market value of Kava company. Next is market value of debt. Market value of Kava company debt. It was given. It was 400 million. 400 million. 400 million. Okay, now we have the market value of Kava company, we have the market value of Kava company debt and equity. So let's calculate the cost of equity. So as Kava company is operating in the coffee business, so coffee company average asset beta is 1.15. 1.15. Beta asset of coffee business. 1.15. Let's calculate the beta equity of Teva company. That is equal to 1.15 beta asset into market value of equity plus market value of debt into 0.8 divided by market value of equity. So it is equal to 1.46. Now let's calculate the cost of equity. Before calculating the cost of equity, risk-free rate and risk premium, write the risk premium. Risk-free rate is 3%, premium is 7.2%. 3%, 7.2%. So let's calculate the KE. KE is 3% plus beta into risk premium. 13.49%. So everything is okay till now, guys? Any issue, any problem? Okay, next is KE is done. Next is, let's calculate the KD. Previous KD was 4.1%, but after the acquisition, KD will increase by 0.3. So KD has become 4.4%. So KD is equal to 4.1% plus 0.3% into 0.8. So KD is 3.52. 3.52. So let's calculate the cost of capital. So market values are given. Cost is given. Multiply the cost with the market value. Multiply the cost with the market value. Calculate the total of market value. Calculate the total of cost. And the WACC will be equal to convert this into percentage, 11%. So WACC is 11%. This is appendix number 1. Beta of coffee business is given. Beta of coffee business is given. Second last paragraph, exhibit number 3. The average beta asset of the coffee business is estimated at 1.15. It is given. Okay. Now let's calculate the market value, because requirement is estimate the value of Teva company share. Now let's calculate the market value. Detail is given here. Sales revenue is 4,500 currently. The whole C company sale is 4,500. And Teva company share is 20%. Our share is 20%. And it is estimated that after Teva company is demerged, growth will be 6%. So guys, let's solve this. Market value of Teva company. put the dollar sign. Years, 1, 2, 3, 4, 5 onwards. First of all, write the revenue. So revenue are C company revenue is 4,500. 4,500 and our share is 20%. And our share is 20%. C company revenue is 4,500 and our share is 20%, and it will increase by 1.06%. 954 is the revenue. Okay, somebody has asked question that what was 1200.5. This is the market value of Canva company. How I have calculated? First of all, I have calculated the shares of C company. Then I have multiplied the C company shares with its market value. And it is clearly written in exhibit number 3 that Canva company market value will be the 24.5% of the C company value. Okay, you are saying that you have the market value, then why we are calculating? This 1200.5 is just the estimate that if we are the part of C company, our value should be equal to 1200. It is not the independent value of the Canva company. 1200.5 is the market value of the Canva company if we are integral part of the C company. This market value will be as an independent market value of Canva company if we are operating as independent unit. In case of demerger. Okay, now the market value which we are calculating, it is the independent market value. So guys, 4,500 market value, 4,500 is the revenue of the C company. Our share is 20% and it will increase by 6% every year, and PBIT will be 21%. So it will increase by 6% every year into 1.06. Copy into the next two cells. Copy into the next two cells. Revenue. Then PBIT is at 21%. 21%. PBIT. Okay, as depreciation is equivalent to the capex, so there is no need to add back the depreciation. So first of all, deduct the tax. Tax is 20%, right? So put the minus sign, guys, into 20%. Then next is capex, additional capex. Additional capex. And it is written in the question that for every $1 rise in sales, capex will be 0.25. For every $1 rise in sales, capex will be 0.25. So let's calculate the capex for year 1. As current sale is 954 and the previous sale was 900. How I have calculated the 900? If let me Control X, let me move to one cell on right side. Guys, currently sale is the 20% of 4,500, 900. So the current sale is 900. So the capex will be 0.25 of the change of sales. 0.25. So these are the additional capex. Additional capex. Calculate free cash to firm. And discount at 11%. That is equal to 1.11 raised to power minus link with the cell. And calculate the present value by multiplying the discount factor with the Fcff. Present value. And for this, from 5 year onwards, from 5th year onwards, growth will be 2.5%. 2.5%. So take the last year cash flow into 1.025 divided by 0.11 minus 0.025 FCFF into 1 plus Z divided by cost of capital minus Z. So it will be equal to 2107 and discounted with the last year discount factor. And the present value of all these cash flows will be market value of business. Market value of business. So it will be equal to 1882. So that's how you will calculate the market value of business. This is the market value of business, by the way. Market value of business. And it was written in the question that it is expected that Kava company will maintain its capital structure after the unbundling. So the capital structure of Kava company will remain same. What is the meaning of this statement? The capital structure will remain same, guys. What is the meaning of this statement? The capital structure will remain same. It is the absolute amount will remain same, or the percentages will remain same. This statement is all about with the percentage, link with the percentage or the absolute amount. With the percentage, excellent. So that means before acquisition, the percentages were, if we calculate, $75% or obviously 25%. 25%. 75% and 25%. So what will be the market value of equity? What will be the market value of equity? 182 into 0.75%. So the equity value will be 1412. So the equity value will be 1412 because it is stated in the question that percentages of the capital structure will remain same. Percentages of the capital structure will remain same. Okay. What will be the number of shares of Teva company? Guys, a statement is given. A statement is given here. Let me there was a statement about the number of shares. Statement of C company is 2000. There was a statement that shares of Teva company will also be same. It was here, I think. Yes. Initially, the C company shareholder will own Teva company on the basis of owning one Teva company share for every C company share. So that means number of shares of Teva companies are 2000. As the number of shares of C company is 2000, its number of shares is also 2000. Market value per share. So market value per share will be 0.71. So market value per share will be 0.71. Okay, that means we have the capacity to borrow more. Previously, if you calculate the debt will be its 25%, right? That will be its 25%. 470. Previously, debt was 400. So that means we have a capacity to borrow more. Okay. You got it, right? Borrow more debt. It's not the increase in value. Debt value will not change during acquisition. Previously, debt was 400. Now you can borrow up to 470. That means 70 more. Okay, let me answer one by one, guys. How come this 2000? Please read this highlighted one. Initially, C company shareholder will own Teva company on the basis of owning one Teva company share for every C company shares owned by them. C company shares are 2000, so that's why number of shares of Teva company is also 2000. Okay. As the shareholders will remain same, so number of shares will be same. Okay, how I have calculated 0.71? Simply dividing 1412 by 2000. Divide 1412 with 2000. Divided by 2000. So what is the percentage gain? Guys, what is the percentage gain? How much there is a benefit? What was the previous market value if you were part of the C company? What was the market value if you still remain the part of C company? 1200. And now what is the market value? 1412. So benefit will be Benefit will be in percentage 17.63%. 17.63%. This is the increase from 1200 to 1400. This is the increase from 1200 to 1400. Benefit is 17.63%. Okay. Let's move to the next part. Requirement number 2. Estimate the additional value, equity value created when combining Layla company and Kava company. So we have to calculate the combined value, then the percentage gain, and then the impact on the capital structure. So they are we will interpret after solving the next part. So let's solve part B, second part, appendix 2. Okay. So this is, first was if you demerge the company. Now you are sale of Cavaco to this Lalaco. Okay. So if you sell Cava company to this Lalaco, you have to calculate the combined market value. So guys, how to calculate the combined market value? You need to calculate the combined market value. Combined market value of equity. So before that, you need to calculate combined equity. So acquired equity is given. Sorry, you need to calculate combined earnings. Earnings, it is given. Cava earnings is given. And synergy is given. So what is the earnings of Layla company 171? What is the earning of Cava company 117.1? And what is the synergy? 62. Synergy is 62. So this is 62. This is 171. This is 117.1, right? So combined earnings will be sum of these three. 350. Now calculate the average PE ratio. Average combined PE ratio. So how to calculate this? It is given here. After the acquisition, it is expected that, please read it carefully, this yellow highlighted, after the acquisition, it is expected that PE ratio of the combined company will be the midpoint between the two individual company PE ratio. Okay, so let's calculate the PE ratio of Layla company. PE ratio of industry is 15.61. Layla company PE ratio is 10% lower than this, 15.61. So Layla company PE ratio is 10% lower than the 15.61, 14.05. Okay, now calculate the Cava company PE ratio. So can we calculate the Cava company PE ratio? Cava company profit after tax is given. Cava company earnings is given. If Cava company market value is given, we can calculate this PE ratio. Okay, guys, Cava company market value is given. 1200.5 divided by Kava company earning is given 117.1. So it is equal to 10.25. So the average is equal to average is 12.15. So let's calculate the combined market value of equity, combined earnings into combined PE ratio. So the combined equity value is 4,253. 4,253. Okay, now let me clear one thing. Some of the students are saying that why we have used 1200 in calculation of PE ratio. Why we haven't used this value, this 1412. You can't use this because guys, there are two choices. Either you will do the demerge or you will sell to the Layla company. If you do the demerge, obviously you can't sell to the Layla company. And if you are selling to the Layla company, you will not do the demerge. So that's why I'm using the previous value, existing value. Okay. So combined equity value is done. Combined equity value is done. Any question? So combined equity value is done. What is the market value of Layla company? What is the market value of Kava company? Kava value is given 1200.5. What is the market value of Layla company? Okay, it's not an issue. Layla company PE ratio is given. Layla company earning is given. Layla company market value is given. So guys, this is combined value. This is pre-acquisition value. So what is the total synergy? What is the synergy? 4253 minus 2400 minus 1200. This is the synergy benefits. 651. 651 is the synergy benefit. This is the additional value created in this process. This is the additional value created. Look, additional value equity created from combining the companies. 651 is the answer. 651 is the answer. Okay, there is a question that how we have calculated Kava company PE ratio. I have divided 1200 over Kava company earnings. Kava company previous market value was 1200 divided with the earnings. P is the price, E is the earning. Divide the price over the earning, it will be equal to 10.25. Okay. Now let's calculate the percentage gain. First of all, calculate share for share offer. Pre-acquisition value. Pre-acquisition information. Shares. Market value per share. It's not compulsion that you have to write every information. Write all the information which is available. Acquirer is Layla company, target is Kava company. Number of shares of Layla company is, what was the number of shares of Layla company? Is it given or not? I think it is given. The number of shares of Layla company is 1200, right? It was given somewhere 1200. Okay, it was given somewhere. Yes, 1200 million shares. 1200 million shares. and Kava company shares are 2000. Pre-acquisition values are given. Pre-acquisition values are given. If you want to calculate market value per share, otherwise it is not required. Something is off with the combined market value of equity. Is there any issue? I think it's fine. It is okay. Combined value is okay. It's perfect. Okay, guys, we are calculating share for share, right? The pre-acquisition information, share, market value per share, total market value. Try to complete this. If you unable to get the total information, don't worry about it. Try to fill it as much as possible. Try to fill it as much as possible. Don't worry about if something is missing. Don't worry about that. Okay, now let's write the post information. Shares of acquirer will remain same. That is a rule. Shares of acquirer will remain same. Okay, now write the combined value of equity. We have calculated that 4253. Now, what we are offering to that company? One Leila company share for every 3 shares of Kava company. For every 3 shares of Kava company, for every 3 shares of Kava company, we are issuing 1 new shares. Okay, there is a question that how we have calculated market value per share. How did we get Kava company market value share? We have calculated Kava company share in the first part. That was the first part which we have done. 1200. It is the same 1200. Okay, guys. How many shares we are issuing? We are issuing 1 new share for every 3 shares. We are issuing 1 new share for every 3 shares. So the number of shares will be 666. Calculate the number of shares, guys. Calculate the market value per share. It will remain same. It will be same. It will be same for 3 cells into. Now calculate the percentage gain. Now calculate the gain. Gain will be total post acquisition value minus pre acquisition value. Now calculate the percentage gain. That's how you will calculate the gain. Please complete this. Guys, please complete this. Okay, there's a question that what about 066? What is 066? .66. What is 0.66? Number of shares. 0.66 is the cash offer. First of all, we are solving the share offer. Share offer is separate, cash offer is separate. It is written cash offer of 0.66 for a Kava company share, or look, or is given, or 1 Leila company share for every 3 Kava company share. So you have to solve in 2 tables, share for share separately, cash offer separately. You will solve cash offer separately. Okay. Okay guys, now cash offer is very easy. Simply copy this. Obviously, there will be some problems during the copying, but don't worry about that. Don't worry about that. Here of cash offer, write the market value again. Write the number of shares again. Write the combined value here again. Okay. Okay, now you are offering the cash 6.6 for every share. 6.6 for every share. 6.6 for every share. Six point six or 0.66. What I've done wrong. 0.66. Sorry, 0.66. So we are offering 0.66 for every share. 1320. And the remaining answer will be belong to the acquirer. So that's how you will calculate the gain. So automatically answer will be calculated. Okay. Where is market value of a share is given? Where I've written that? By the way, market of share means market of equity. Market of share or market of equity both are same. Yes, gain synergy, total synergy will remain same. Total synergy will remain same. 4253 is not for the cash offer. 4253 is the combined value. 4253 is the combined value which we have calculated above. 4253 is the combined market value of equity. Okay. 4253 is the combined market value of equity. So let me explain the cash offer, guys. Simply write the pre-acquisition information. The shares of acquirer will remain same. Then write the combined value which you have calculated above. 4253. And then you will write that how much shares you are, how much shares you are, how much cash you are giving. You are giving $0.66 for every share of the Kava company. So that means you are distributing 1320. So if 1320 are giving to the Kava company, remaining will belong to the Lala company. Then calculate the gain by taking the difference of post acquisition value and the pre-acquisition value. And calculate the percentage gain by dividing the gain with the pre-acquisition value. You mean when we buy a share in market, we are just paying for its equity value? Yes. Whenever you are buying a business, you are paying for its equity. When you are buying a business, when you are buying any company, any organization, any running business, you are paying for its equity, not the whole business value. Okay. Okay, guys. Now another requirement. There is another requirement that calculate the capital structure. Capital structure. Impact on the Leela company capital structure under each payment method. First of all, calculate the current capital structure. equity value and debt value. Third requirement, 40 is the debt, 60 is the equity. 40 is the debt and 60 is the equity. 40% is the debt and 60 is the equity. And by the way, equity value was given, right? Equity was 2462. So let's calculate the debt value, guys. It will be 1601. Market value of debt. This is the current capital structure. Okay. This is the current capital structure. So what is the capital structure and share offer? What is the capital structure and share offer? Okay. In share offer, what is the total equity now? What is the equity of the group now? 4253, right? In share offer, what is the total equity now? We want to calculate the debt equity ratio. So this is the combined debt 4253. And what is the, sorry, combined equity 4253? The combined equity. Now let's calculate the combined debt. The previous debt of Leila company was 1601 and the previous debt of Keva company. Do you remember what was the previous debt of Keva company? Anyone remembers? What was the debt of Keva company? 400. Excellent. It was 400. Total is, yes. So what is the percentage? $6,254 share offer. Now let's calculate the cash offer. Cash offer. So equity value is, now what is the equity value? Now what is the equity value in cash offer? In cash offer, you only have 2933. Why? Because you have paid 1320 to the other company. Now 4253 is not the total equity value. Equity value is 2933 because you have paid 1320 to the other company. Equity is 2933. What about the debt? Previous debt was 400, right? Previous debt was 400. Previous debt was 1601. Plus you also have raised the new debt. What was the new debt? The cash which you are paying to the Keva company will be financed by raising the new debt 1320. 1320. So in cash offer, your debt has increased significantly. Your debt has increased significantly. %. Your debt will be 53%. How I have calculated the debt in cash offer, guys? if you are paying cash to the other company. Remember, in cash offer you are paying 1320 to the other company. This 1320 plus the previous debt 1601 plus the previous debt of Keva company 400. So combinedly it will be equal to 400 plus 1601 plus 1320. So in cash offer company will be in severe problem because debt level is 53.1%. 53.1%. So now you have to comment on all this. Okay, before commenting, let's calculate few more points. One thing. Capital structure, keep the capital structure in front of you. Also the percentage gain in front of you, plus in share for share, what is the ownership now? In share for share, what is the ownership of Leela company? And what is the ownership of? Always calculate ownership. Always calculate ownership in case of share for share of. Why is 4253 is equity value under the share of? In share offer, 4253 is the value. Because in share offer, the acquirer and the target both will become the owner of the company. So the combined equity will be 4253. But in cash offer, you have paid 1320. So that's why equity value has decreased. Okay. So let's discuss one by one. First of all, if you sell the market value of, if you sell the Keva company independently, if you make it a separate company, how much is the gain to the parent company? 17.63%. 17.63% approximately. What is the gain if you sell the Keva company independently? 17.63. And if you sell the company through share for share exchange, what is the gain? What is the gain? 27%, 26%. This is the gain to the target company. And if you sell through the cash offer, gain will be approximately 10%. So guys, which offer is lucrative? If you sell the company independently, your gain will be 17.6. If you sell through share for share, your gain will be 26.55. If you sell through cash offer, your gain will be 10%. So which one is the best if from the Keva company perspective? Anyone? Share for share, right? But obviously we have to explain it. First of all, if you compare the independent offer with the cash offer is not that lucrative. In cash offer, the only gain will be 10%. If you sell it independently, gain will be 17.63. And if you sell it independently, you still have the control on that company. You are still the owner of that company. But in cash offer, your ownership will be gone. You will not be part of the group. And if we compare, share for share is the most lucrative, where gain will be 26.55%. But still, it's a share for share offer. In share for share offer, the problem is that whether we will be able to realize this value. If we want to sell these share in the market value, whether we able to realize the 26.55% gain. Whether we able to realize that gain, because if Leela company, it was written, Leela Company is a large unlisted company. Leela Company is an unlisted company. So where you will sell these shares in the market? We know that market value of unlisted company is not marketable. Marketable, do you know the meaning of marketable? That if you sell the shares in the market, you will not be able to get this value. Although the gain seems to be very lucrative, 26.55%, it seems to be lucrative, but this is a share of unlisted company. Where will you sell these shares? You will discuss this point, right? And then if you accept the share for share offer, your share will be your gain will be 35.7%. Leela Company control will be significant, 64.29. They have the control, and you are the minority shareholder of the you will be the minority shareholder of the group. So it is a point of discussion whether you will get the full rights or not. So from the perspective of Keva Company, it seems that share for share offer is the most lucrative one. So now let's discuss from the perspective of Leela Company. Share for share, in share for share offer, gain is almost 14%. In cash offer, gain is 22%. Which one is better? For 13% or 22%? From the perspective of Leela Company, which one is better, guys? Cash offer, right? But there are certain problems attached with the cash offer. In cash offer, if you accept the cash offer, your debt proportion will increase from 40% to 53%. There will be a significant increase in debt. Your company can be in severe problem. And if you accept the share offer, debt level will fall. You will write that if this is the ideal debt level, and if you move from 40% to 32%, that means you will forego the tax saving on the interest. You will forego the tax saving on the interest. And another problem with a share offer, your gain will be lower. Another problem with a share offer, you will not control 100% of the company. Your control will be 64.29%. Your ownership will be diluted. Your gain will be lower. However, your company will be safe. Your company will be less risky. But the point of discussion here, if the debt is lower than the ideal level, the optimal level, that means you are losing the tax shield, you are losing the tax saving on the interest. Okay, so guys, you will be writing a report to the board of directors. You will write the subject, intro should be smaller, and then you will write the financial and other factors, both from the Leela Company and the Keva Company perspective. And you will also discuss the capital structure, the ownership, and then you will write the conclusion. And obviously conclusion, it seems that share for share is the most beneficial one from the perspective of Keva Company, and share for share is also beneficial from the perspective of Leela Company because you can't recommend the cash offer. In cash offer, there is a significant increase in debt. Okay. Report will be written in the Word format. In the Word format. To the board of directors. of the company. Then you will write the subject. Subject should be smaller. Discussion of the financial and other factors. Discussion of financial and other factors from perspective of both company companies shareholders. Then you will write the introduction. Introduction para. Highlight that. Okay. Then you will write the financial and other factors. Financial and other factors, and the impact on, what was the last point? The impact on capital structure. Impact on capital structure. Conclusion. Report compiled by date. So obviously it will not be that small. You will have to fill this introduction, financial and other factors, impact, and you will have to refer to all the appendixes. Analysis subject will be analysis of financial and other factors for Leela and Kava company shareholders. Excellent. It is obviously it is good. Will you talk about the appendix? Yes. In financial and other factors, you will discuss appendix number 1, that if we sell it independently, market value will be, the gain will be 17.63 according to the appendix number 2. If we sell it to the Leela company, the share for share gain will be this, the cash offer gain will be this. So with reference to the appendix, you will explain. Or there is another way, that is simply copy here. Percentage gain, make a small table. Gain. All of these are gain. Demerger. Share offer. Cash offer. And then write the gain here. Percentage gain of Leela, percentage gain of Kava, and write the gain. Like the gain here is for the 17.63% or 22% or 21%, whatever the gain. And then it is easy for you to discuss this. Okay, you can make a table and now discuss all the stuff here. Demerger has no impact on the board of directors of Leela, but it has one impact, that is, if demerger is more beneficial, you will write to the board of directors of Leela company that demerger is more beneficial. Kava company will not be agreeing on the proposal of Leela company. So that's why it is relevant. Would they tell you your role within the company to fill the compiled by? No. Do not fill report compiled by. Can we copy the table from the calculator to process calculator? How can you copy from the calculator? From Excel, okay. But in Excel, you haven't written this like in a, you haven't written this in a table form. But let me try to copy that. Let be able to copy or not. No, it will not be copied. Okay, you have to make a table here. If you do not want to make a table, then you have to refer to the appendix. Okay, guys. So tomorrow we have a plan to solve questions on the restructuring. Firstly, we will quickly, if we already create the table, if you create the table in the Word format, then there is no need to refer to the appendix, because when you are making the table, you already referring it to the appendix. This is appendix number 1, this is appendix number 2, appendix number 3. No. In conclusion, it is not like accept or reject. In conclusion, you will select the most appropriate offer. Like here, the most appropriate offer is share offer. Why the share offer is most appropriate? Because if you compare from the Kava company perspective, it has the highest gain. If you comparing from the Lela company perspective, although its gain is lower, but it is still better than the cash offer, because in cash there was significant increase in debt. So that's why share offer is better. Okay, it's not like accept or reject. Conclusion is the explanation that which offer is the most appropriate one. Should I put the appendix of the number in the Word table? Yes, you have to put, because where you have, why you have written 17.63, where have come this number? So you have to write that appendix 1 like this. If we have calculated the wrong amount, our conclusion and explanation will be wrong, will still get marks. Yes, on figure rule. I have explained yesterday on figure rule, you will get the marks. You will not get the marks for the calculation, but you will get the mark for conclusion and the explanation and the remaining part. Okay. Would you please recalculate debt in cash offer? You are saying that if cash is not provided, debt is provided, right? So instead of writing debt, write market value. Instead of writing cash offer, write market value of debt here. Market value of debt here. Okay. Write market value of debt here. You have to calculate the market value, then you will write market value of debt here. Is it necessary to create this table in the Word? No, it is not necessary. It is not at all necessary. If you are able to give the reference to the appendix directly, it is totally perfect. In the capital structure, recalculate the debt. Okay. In the cash offer, right? In the cash offer. Okay, previous debt was 1601. This was the debt of Leila company. Previous debt of Kava company was 400. And we are transferring 1320 cash to the Kava company. How? 2000 into 0.66. From where you will get this cash? You have to borrow this amount 1320. So if you borrow this amount 1320, so the sum of all these will be, sum of all these three will be 3321. This is the debt. Okay. Okay, guys. Tomorrow we are going to discuss question on the restructuring. Okay, and I will try my best to solve one question on the Black-Scholes option pricing model as well, so that we have a grip that how to solve the Black-Scholes option pricing model. So tomorrow, please do revise restructuring before the session. Okay, thank you so much, guys, for joining in. And if you guys have the question, yes, I'm telling the same one. We will solve the latest question on the restructuring. We will solve the latest question on the restructuring. Okay, and please wait and let me copy the link of the group. Please wait, guys. So I have sent the WhatsApp link. Those who haven't joined, please join. Okay, guys, thank you so much. Take care. Thank you so much. See you tomorrow.